Okay. So first of all, I wanted to talk about, so you're writing a book, and I'm kind of doing this as you've never done this before, this is brand new. And so I was just going to very quickly go through different entities. The most common entity would be a sole proprietor, in the US would be on a Schedule C, which you would file with your normal income taxes. We would normally recommend that somebody forms an LLC, and what an LLC can do, and I will get into that a little bit further on another slide, but it can just give you some legal protection. You will still file your taxes like on your Schedule C, but that LLC is in a way kind of separating your business from you. And so it will then create a different entity. Another type of entity is a partnership that will have two or more owners that will file its own tax return. So your entity would be a separate tax return, a separate business in the IRS's eyes. And that would include one or more owners. And partnerships can get very, very complicated. Along with the next one, S corporations, those we recommend forming later on. Usually they can have a lot of benefits, saving on self-employment taxes, but they also bring in a lot more reporting. You have to pay yourself a payroll. You will have to take out payroll taxes, file payroll tax reports, usually quarterly. Those will be for your federal and whatever state you're in, or other country, of course. But so the S corporations can give you a lot of savings, but you usually won't really benefit from those savings until you're in that about $50,000 to $60,000 income range. It also will file its own tax return. It will have to have an EIN. It will produce a separate form called a K-1, and that form is what you will file your personal taxes with. And so your taxes, your income will then be passed through to your personal return through that form, and that is how you will pay tax on your income with an S corporation. A C corporation, I usually don't advise on these just because they're very, very complicated, and the tax rates can change. The Tax Cuts and Jobs Act actually instilled a 21% tax rate across the board for C corporations. However, that law could change. We could have something different come into effect. And when that happens, if you wanted to convert back to an S corporation, you can only do that once every 5 years, and it requires IRS approval. And so sometimes it's not really good to get into those unless, your accountant or your lawyer advises you to do that. I just wanted you to kind of be familiar with some of the different types of entities. And I'll break them down just a little bit further. So forming an LLC can actually be very, very simple. That LLC pretty much just says, my business assets are separate from me and my personal assets. So if somebody sues you, they can't come and take your house or your car. They can only take or have, the potential to take assets that are in that LLC. An LLC will be established in your state. You can actually go to some different websites to do it yourself. You can use a lawyer or an accountant to assist you. But if you're, trying to kind of keep your expenses low and you're wanting to set it up yourself, there's some different websites, LegalZoom, NOLO, and Zen Business. You can just pay them a fee. You will have to, most states will require somebody called a registered agent, and that's pretty much just a person that lives in that state, that has a physical address in that state, and that address in some states can actually be made public. And so I'll get into later kind of, using a PO box to solve that problem, because you don't want your personal address made public knowledge. And so that registered agent can be you. It can even be just somebody who has a permanent address, a business or individual that has a permanent address in that state. And so a lot of people will just have their accountant or lawyer be their registered agent. They'll receive any correspondence sent by the state to that person at that address. And so some people kind of freak out. They're like, what's a registered agent? And so that's essentially what it is. It's just so the state knows how to communicate with you if they need to. The next one, so an LLC, if it's just you as an owner and you're not a Schedule C, or I'm sorry, you're not an S Corp, you will file a Schedule C. So in doing so, you're having this extra income come in. Well, the extra income is going to generate extra tax that you're not having withholding on. And so that can lead into making estimated or quarterly estimated tax payments to the federal, the IRS, and possibly to your state, depending on your state's income tax laws. And so some people will make this extra money and then they'll come bring all their forms to get their taxes filed. And then, we have to explain to them, you owe a whole lot more money to the IRS than you initially thought because you were not making quarterly tax payments on this extra income. And then if it goes into the following year, you can get penalized for that. And so that will increase your income tax penalties. Schedule Cs are eligible for, it's called the Qualified Business Income Deduction. This is a deduction that domestic companies can take, decreasing their income. You will be exposed to self-employment tax. If you make more than $400 a year, you will pay self-employment tax. And so that's extra taxes that will be added to your return. And if those do exceed $1,000, all of your tax due, you will then need to start making quarterly tax payments. Schedule C, a common thing we'll see on Schedule C, and I'll go into it a little further in some other slides, is the home office deductions. The home office, there's two different deductions. There's the simplified, and then there's the direct expenses. And the direct expenses is where we will take all of the expenses that you have put into your home, your utilities, any repairs you've done, your property taxes, all of those things, list them out, and then we will take the square footage of your office versus your entire home, and then that ratio is how much expenses you will get to take. The simplified just goes by the square footage of your home, and many times will give you a better answer than taking the direct expenses. There's usually depreciation factored in there, and this is where you will want an accountant, because that can, if you sell that home later on, it can affect the basis of your home. And so that's one thing to kind of stay on top of. You can deduct, sometimes you can qualify to deduct your health insurance on your Schedule C. Sometimes it'll go up to 100%, so that if you're paying, if your Schedule C is your sole income, maybe you don't itemize, maybe you don't have enough to itemize, but you can take your health insurance on your Schedule C and deduct 100% of that against that income also. And so a lot of people don't know about that. The next one, so if, say, you are in that $50,000, $60,000 and higher range, you can file a Form 2553 and convert your LLC to an S corporation. That will create a whole new entity. And again, it is very good this is where I would go with an accountant or a lawyer, somebody who has the knowledge on how to set these entities up and kind of guide you through it. But you will set up the S corporation. It will become its own entity. It will file its own tax return. You will have to pay yourself a payroll. And so this is where getting with a payroll service like ADP or Paycom, some of those big ones, can be very beneficial, because they'll do all of those payroll taxes for you. There's also some kind of self-serve. QuickBooks has a self-serve platform as well, to where you can put in your information, and then they'll take care of all of those quarterly tax returns for you, because those tax returns there'll be 4 of them a year for the 941 for your normal payroll taxes, and then your unemployment FUTA taxes will be a 940 that's done at the end of the year. And so that return will create a separate form called a K1, And then that K-1 is what you will give your accountant to file your taxes. Okay, so I'm seeing some questions come in. I've been struggling to find a reputable and affordable accountant. Are there any places you can recommend one? So anybody that is registered, as far as in the US, they will be registered with the IRS. You can go to irs.gov and search to find anybody that's like you would find me on there, any CPA, enrolled agent, anybody who is eligible to represent people to the IRS. And so that's one way to find. One of the best things to do is ask your friends and family. That would be a good place to start. Is I know even at the firm I work at, we work off of referrals. And so it's usually friends and family who refer each other. So I would start with who you know first. And then if you don't know anybody that uses an accountant, you can search online. I would definitely try to keep somebody local. If I guess it's beneficial to keep somebody local because they're going to be a little more informed on your laws where you live. This says if you co-write with another author in a different state, how do you avoid overpaying income tax? Because Amazon only pays one author. That would more than likely, that would be something you would need to, there's different options on that. And that's where you would need to seek the advice of a lawyer or an accountant to help you set that up. I can think of about 15 different ways you could handle that. And so that's where you would want to get some advice with somebody in your specific situation. Will the IRS notify you when you have to pay quarterly taxes? No, they will not. You will just have the penalties calculated in when you file your tax return. Your accountant will usually factor those in. If your accountant doesn't, then the IRS will send you a letter saying, you still owe these penalties for not paying your quarterly taxes. Would you suggest starting a solopreneur or go right into having an LLC? That's a good question too. So I guess it depends on you and what you want to do. I would suggest starting off forming everything you can in the beginning, and I'll go into that in some future slides, but having that LLC will give you protection from the start. It will give you the documentation you'll need to open a bank account specific for your business. And so I'm going to go into that here in some slides too, and I think I'll answer your question on that. So the next thing I wanted to talk about is deductions. I will go into how to keep some of these records, but I wanted to touch on first, what records do I need to keep and why? So you get this income as an author, what can I deduct from that income to pay less taxes to get my net income? So the first one, advertising and marketing. So that can be, and some of these can kind of overlay into other areas, and it's not a huge deal. This is where having a good tax accountant can help you kind of determine where to code some of these things. But so if you're paying someone to handle maybe your social media accounts, or you're paying for ads, paying for Google ads, Facebook ads, any kind of advertising and marketing, you can write, if it's for your business, you can write those expenses off. Business insurance is another one. Usually starting out, you won't really have a need for this, but getting further in, you can. One thing I see commonly is cell phones. Now, cell phones are kind of tricky because unless you have a cell phone that is only used for your business, you're using it personally, you're going to have to try to determine how much of that is used for your business and how much are you using it personally. Is it like half and half? Is it maybe 75 and 25? That's something to discuss with your accountant. It's always easier to separate as much as you can. And that's less that you would have to argue if you did get audited. And so having, I know people who have two cell phones. They have a company cell phone and they have their personal cell phone. And that way, they know this bill is fully, right, fully deductible because I don't use this cell phone for anything but my business. Computer hardware and software, if you're paying for editing software, Microsoft 365, if you're using Word, or Google, or any of the different platforms that you're using to actually type, Adobe, any software, even apps that you're using to help you in your business, you can deduct those expenses. Postage that you pay to send maybe packages, or even just if you're putting something in the mail, that is for your business, that's deductible. Professional services, so legal and accounting. So on accounting, this can get a little tricky too, but this is something I do for my clients. So if I am preparing a Schedule C for them, when we do the bill, we will break out how much time we think we spent on their Schedule C versus their other expenses. And so you may not be able to write off your entire bill for your accountant, but you will be able to write off a portion of it, the part that's for your Schedule C. If you're an S Corp, you'll get to write off the entire thing because it'll be just for that tax return. Any office supplies that you buy, that's for your business. Those are deductible. If you do rent an office or a place that you only use to write, you can write that off. Okay. Transaction charges. So if you use any sort of credit card processing, like Square or QuickBooks Payments, I know there's thousands of those out there. Those charges, those are deductible. Web hosting and services, that can be even the fees for, things like Zoom, those are deductible against your business income. Research that you do for your research that you're doing for your books is deductible. Again, some of these you've got to be kind of careful with. Some people will go take, maybe they're writing about somebody who cooks, and so they go take a cooking class. If that is only because they're writing about, a character that cooks and they need this kind of knowledge to make it more accurate, you can potentially write off some of that. Again, these are the type of things that can get into a gray area. So it's good to discuss these with your accountant before you do them, so they can let you know if what you're doing is deductible or not. Editing and design, I kind of covered that before, but even if you're paying somebody to edit for you or consult, you can deduct those expenses. Membership and submission fees, those also deductible. Subscriptions, even if you subscribe to a magazine or journal to research, that would be deductible. Conferences, so if there's a conference that's for what you're doing, you can deduct that. Any continuing education, and of course travel, if you're traveling to events, if you're traveling places to promote your book, all of the mileage, the airfare, potentially the hotel costs, and the meals can be deductible. That is a conversation to have with your accountant also, because if you're doing non-personal things on this trip, then that can get where we've got to start calculating portions of what days were you there for business and what days were you there for personal, because you won't be able to take those personal expenses against your income for your business. Okay, I wanted to look. If a book is released at the end of the year, do the royalties need to go to next year? So whenever you start receiving payments but from a publisher or from anyone, if they pay you more than $600, you're going to get a 1099, and that will reflect the year that it was paid. So if you release a book at the end of the year, say you release a book in December, did you receive any money for it? If no, then nothing's going to happen. But say you received money for the book, December 31st, then you're going to get a 1099 for that tax year, and then you'll pay the taxes in the year that it was earned. But say you release a book in December and you don't receive any money for it until February. of the following year, then that income, when you received it, will be in the year you received the income. And so this is where you can get into cash basis versus accrual basis. Most people will be cash basis in the beginning until they start getting into that S Corp range. That's something to discuss with your accountant. But when you receive the actual money is what tax year it will affect. If you buy a new computer, can you take a deduction or partial deduction on that, or does it have to be used only for business? That's where you need to have the conversation with your accountant on that. But typically, if you buy a computer that is only used for your business, then you can take 100% of it. Now, if that computer ends up being, you pay more than $2,500 for that computer, you can run into needing to depreciate that item. And again, a conversation with your accountant on that. It's rare that I see people spend more than $2,500 on computers. Usually I see that more with gamers. But if you're spending less than $2,500, then you can write off 100% of that computer the year that you buy it, if it's used fully for business. If you are only maybe using half for business, half for personal, then you may be able to write off half of that computer, in that tax year. That's a conversation to have with your accountant as well. That can get pretty tricky if you're when you start mixing business and personal, this is where it can get very, very tricky. So we kind of went into, what are some deductions? And so I was going to kind of give an overview on what records, how to keep those records. If you're just starting out and you're trying to keep your expenses low, just a good old fashioned Excel or numbers document, just a spreadsheet of your transactions, the date, the amount, description, and then what it was. Sometimes I will have clients just send me these and I will categorize them and create a pivot table. Those are pretty easy to do. In fact, I think Microsoft has little tutorials if you're, into DIY. You can watch pretty quickly on how to make some really simple pivot tables to track your expenses to put on your Schedule C or whatever entity you have. QuickBooks Online, self-employed, they have other higher level versions as well. But if you're just starting out, it's like $15 a month. A lot of my clients use this. You can actually, so if you open the bank account for your company, you can actually link that bank account to QuickBooks. And every time you use your company debit card or write checks, it will feed into QuickBooks. And then you can go in there and code those transactions, or your accountant can, and then print off reports that will summarize your expenses for the year and your income. Another option is Xero. I'm not as familiar with the last three, Xero, FreshBooks, and Wave. I know they're all reputable. I believe Wave has a free version. I think it goes by how many transactions you have. But if you're just starting out, this could be really handy for you. But just getting some way of tracking what your expenses are and what your income is can also decrease your tax bill as well. Because most accountants will charge hourly. They'll have an hourly rate that they charge. And so the more hours they're spending, or if they're having to get into bookkeeping for you, your accounting bill can go up. And like I had said before, if you're trying to keep your expenses low, providing everything to your accountant, nice and neat and just what they need will keep those expenses down, especially early on when you may not be wanting to put that much money up front. So these are just some kind of more random tips. Keep your business separate from personal. And I cannot stress that enough. And it will happen. Like if you set up that separate business account and you're in a hurry and, you grab the wrong debit card and pay something out of, personal out of your business account, just indicating that, in whatever record keeping software you're using, we can exclude that from your deductions. But the best you can, if you can keep it separate, just treat your business as it is separate from you, it will create less headaches in the future. Opening a separate bank account can be very helpful for this as well, and just only paying for company, for your business expenses out of that business bank account, because a lot of the records that we're going to keep are going to come through the bank account. Probably 90% of the record keeping, especially early on, is going to run through that bank account. And so that's one of the first things I tell people to do when they want to start up a business. Opening a separate mailbox, I kind of touched on this before. If you form an LLC, you're going to have a registered agent. And if you do choose yourself, you're not going to want your public address. Like I said, some states will post that address publicly. And so having a little PO box can solve that problem. Home office, definitely talking to your accountant about a home office and how, deducting. Home office can be kind of tricky because it's got to be a designated area for your business. So you can't be, having just a desk in your bedroom and then write off your bedroom, because you're not just using your bedroom for your office. And so some people want to start jumping on the home office when really it doesn't qualify. But if you do have a room that's a designated, you can potentially write off the furniture. You can write off, the computer, hardware, software. A lot of the things we listed in the deductions will qualify in that home office deduction. Tracking mileage. Whenever you do travel to promote your books, tracking that mileage, either just handwriting a log using an Excel file or a spreadsheet to track, the date, where you went, the miles you traveled. And then you can deduct 58 cents per mile for any of those business trips against your income. And so again, there's kind of two options here. You can track by keeping all the total expenses, keeping, the gas, the receipts for gas. And that can be tricky because, how do using the little trip indicator and knowing exactly how much gas you use to get from point A to point B can be kind of tricky. And so usually it's a better answer for people to just go ahead and take the 58 cent per mile deduction. And then all you have to do is track the mileage. You're not having to track all of your oil changes, all of, how much gas you put in and all of that. It's already kind of factored in. And then also a little wear and tear on your vehicle is also factored into that 58 cents per mile. If you are using people to help you,
Sean, here's your reminder.
Oops, I'm so sorry. Alexa, stop. Sorry about that. Hiring people to help you with your editing, or even like a personal assistant, which that assistant would need to be more helping you with your business, not your own personal dental appointments and things like that. But if they're helping you book flights and they're helping you, even agents helping you, you can pay those people and deduct it. However, if you pay them more than $600, you will need to file 1099s every year with how much money you paid them, and you'll provide them a copy as well. Then the other issue to get into is this a contractor or is this an employee? And so that's another thing to discuss with your accountant is, I have this person doing this, they're doing these duties. Are they a contractor or are they an employee? There's different qualifications. I could do a whole webinar just on that. And so that is definitely a conversation to ask about if you are having if you're paying other people to help you, even other artists, anybody that you're paying to help you with your business. That is definitely a question to ask. So the next thing I wanted to kind of go through is what you're doing a hobby or is it a business? The problem is if the IRS determines you're a hobby, you will have to pay tax on your income, but you don't get to take any deductions. But if it's a business and it goes on the Schedule C, you do. And so one thing you do not want to happen is for the IRS to audit you and determine that all of that income you made, you don't get to take any expenses because it's a hobby. One of the best indicators is the IRS believe, the IRS has the stance of if you have a business, your goal is to make money. And so if you don't make profit for 3 out of the last 5 years, that is one of the biggest flags that can get you audited and get you classed as a hobby instead of a business. And so that's not always true. There's extenuating circumstances. And so this slide is directly from the IRS website. I put the link on here. If you want to look, there's more on the page. But they will kind of determine, is this a business or is this a hobby? Are you, the first one, are you carrying out the activity in a business-like manner? Are you maintaining complete and accurate books? That's one of the first things they look at. Are you keeping good records? The time and effort that you put into the activity needs to show that you intend to make it profitable. Are you depending on the income for your livelihood? Even part-time, it doesn't have to be your entire livelihood, but is this actually contributing to you, or are you just taking losses every year? Sometimes you may have losses for 4 or 5 years. But very good example is COVID. A lot of businesses had to close up, and so they may have had losses in previous years, and then COVID, created even more losses. But they can argue that next point, the losses are due to circumstances beyond my control. COVID was a perfect example of why I would still have losses for several years, because there were extenuating circumstances. And it doesn't have to be a pandemic. It can be other issues within your business as well. Looking at, do you have the knowledge needed to carry out the activity as a successful business? And that one's usually pretty easy to argue, especially for authors. You're writing a book, and so you have the knowledge for the books that you're writing. Were you successful in making a profit in similar activities in the past? This is just, again, going by, are you qualified to run the business you're running? And yes, I mean, that one would be very easy to argue. And then whether it makes profit in some years, how much it makes, and whether they can expect to make a future profit from the appreciation of assets. That one wouldn't really apply to you all as much, because authors aren't going to have a lot of assets in their business. But that is one of the kind of scary things people run into is, I've started this business and maybe I had some losses that I took. What happens if I get audited? And so these are things to kind of keep in mind if you do get that nasty letter. And so as far as records and what records should I keep? Anything, pretty much if it comes in and it has anything stamped on the envelope that says tax forms or tax document, be sure and keep that. Take that to your accountant. Keeping your receipts. Now, you may not need to provide all your receipts to your accountant, but you need to keep them. If you get audited, the IRS is going to want to see proof of your expenses, even if it is huge. They could be paper or they can be electronic. And so some people will even QuickBooks has a feature where you can just take a picture of every receipt and it will actually store it electronically for you, and it'll store it attached to that transaction. Even taking pictures and just saving it in a Dropbox file or any sort of cloud service, just something to have record of what you bought and when and why. Sales slips for direct sales. So even if you are receiving cash, you are still required to record and pay taxes on that. And so keeping those cash slips, or I'm sorry, those sales slips for when you receive cash for any sales you may do. One thing I did list down here. I'll get to it in a minute. Appointment books or calendars. These can also prove to the IRS, like this is a serious business. Like these are the events that I've attended. These are the meetings I've had. Again, a lot of us keep electronic calendars, and those will work just fine, whether it be an Outlook or Google or any of the major calendar email services. Thank you notes from libraries or schools. If you do attend events and they send you those can be good to show if you get audited. Any letters from agents or publishers, bank and credit card statements, PayPal, Square, any of those credit card processing companies, those reports and summaries, and always give those to your accountant as well. If you are doing business with any contractors, you will want to have them complete a W-9, and then that is what you will use to then issue them their 1099. And so you actually, if somebody is working for you, there's this, a lot of people don't know this. If someone is working for you and they are refusing to give you a W-9, you can actually withhold payment from them, you know, if they won't give you the W-9. And so that usually does spark a lot of those people to go ahead and give you the W-9, especially if you're an S corp. They're going to expect you to have those if you are, if you're even taking a contract labor deduction. If there's more than $600 there and you don't have 1099s filed, that can be a risk that you're taking, and there is penalties for not filing those. Sales tax returns, and again, this will go by where you're living. A lot of places, if you're selling even like little stickers or any sort of swag, I guess not swag, but like any sort of items, you know, promoting your book. If you're selling those items, you could be required to file a sales tax return on it. Even in my state, we have to have it and there's no bottom limit. Like if you sell anything to do with your business, you're going to have to file a sales tax return. And then a lot of people ask, how long do I need to keep all these records? I always tell people keep them for 7 years. Keep all of these things I listed, even if you do a different box for a different year, and keep them all together. But don't start throwing that stuff away for 7 years. It's a kind of a complicated answer because there's kind of different records that have different years attached. But if you want to just stay generic and make it easy, just start throwing away every 7 years. I wanted to see, I look like I had some more questions. So they said, Roseanne says, I'm going on a cash basis when it comes to income. How does that work with expenses? I put mine on a business credit card, which I pay every month. Do I count that expense when I purchase or when I pay for it? Does it matter as long as I'm consistent? This has always confused me. This is a really good question, and it is confusing because when you use a credit card to pay for something, you're not going to potentially pay for it for another month. And so when do I recognize the expense? In the case of credit cards, this is where you can, you know, using something like QuickBooks is really good because you can link the credit card in. But even on cash basis, go ahead and record those expenses as they're incurred, as you rack them up on the credit card. Now, this can get kind of complicated, but as you do this, as you use the credit card, record the expenses, even if you haven't paid the bill yet. And I know as a cash basis taxpayer, it can be kind of confusing, but even if you're, at the most, you're going to lag a month. You may, because of, the end of the year from December to January, there will usually be a lag of a month. And usually the IRS doesn't really care so much about that. I've never had any issues with it. I always just have my clients record it as they spend it, as they come up on those statements. And so that is a really, really good question. But yes, whether you're cash or accrual basis, go ahead and just record those expenses as you run them on the credit card, as of the date they were ran on the credit card. That's probably the simplest way I can answer that question. How does it work if we have multi streams of income, books, courses, etc.? So this is where this can get complicated. But if all of it has to do with, okay, say you're an author and you've created a business, support, that you're an author, that is your business and that is what the business is, then anything to do with that can be on all of those streams of income can still come into the same business. But this would work, I guess. So say you're an author and you're teaching or taking courses to help you write your books. All of that can go into one business. But I guess this is where business and personal need to be separate. If you're an author, but say you also teach cooking classes, those are not related at all. in any shape or form. And so you would then need to have two entities. And so it really boils down to, is this something to do with one type of business, or do you actually have two entities going on here? But like if you're an author and you're taking courses and teaching courses on how to be an author, how to write, how to, anything to do with the writing, it can just be a different type of department within your business. And so that can all go to that same business bank account as long as it's related to that business. But again, if you're also a welder, you can't take your welding income and feed that into your author business because they are not related at all. Let's see. If I file an LLC this month, can I deduct all of the expenses from the entire year under that LLC, or only expenses after the LLC was formed? Only the expenses after. Okay, that one's actually, let me rephrase here. You can take, technically they would need to be separate, but if you're just doing an LLC, you will have a Schedule C, and that Schedule C is you. And so if you have a Schedule C, it really doesn't matter when the LLC was formed. You can do one Schedule C for before it was formed, one Schedule C for after it was formed. But really, if you combine the two, I've never seen that cause an issue. My advice is, if you are serious about getting these books published and taking it all the way, form the LLC as soon as you make that decision. It's not very much to do. Using LegalZoom, you can form one, I think, for about $250. You may even be able to find it cheaper. And if you do it yourself, that's even cheaper. It's just some of those other sites will cover your operating agreements and things like that you're going to need to have depending on your state. And so my advice is form that LLC as soon as you're serious about this. But I don't think you're going to have any issues needing to separate the expenses, because it's all still going to go on your Schedule C, and you're not going to be having a different EIN. So all of this will just go on your Schedule C. So I would just keep them all on that same one, just for easiness. Just definitely keep your receipts, but that LLC is not going to determine anything different as far as your taxes. The only way it would is if maybe you got an EIN. If you did go ahead and do an EIN, which I don't really advise that if you're considering doing an S Corp in the future, that can cause you some headache. So I always just tell my clients, form your LLC, don't do an EIN. We're just going to file it on your Schedule C. That's where it's going to go anyways. And so then we don't have this headache of having to do two different Schedule Cs. I hope that answered your question. If not, email me and I'll get more detailed on that. What is an operating agreement? An operating agreement is it's something that you're going to have when you form an LLC. Different states require different verbiage. It's pretty much it's an agreement between you and your business of how you're going to conduct business. If the business, if you shut it down, what's going to happen to the assets? Usually it's pretty standard. You can even find very standard operating agreements online. And then some of those LegalZoom and NOLO, when you set up the entity, they'll just provide you like a plain operating agreement, and it'll ask you questions if you do need to add something extra by what you're doing. But authors aren't going to need to have a lot of that. A lot of that wouldn't apply to you. And so it's pretty much just an agreement between you and your business and how things are going to run. They don't have to be horribly detailed. In fact, a lot of them are pretty vague when it's just one person. Maybe this is a dumb question, but would your LLC be your own name or a different business name? Actually, that is not a dumb question. I get asked that a lot, actually. So what is going to determine by the name of your LLC is your state. And some states have different rules on naming. And so that's where you would need to just get with your accountant or research, how your state requires you to register your business. And so it can be your own name or it can be a different name. Just understand that whenever you set up these businesses, when you set up this LLC, anybody can find it. And so if you don't want your real name out there, you don't want to call your business that name. If you do, and you're okay with that, then by all means, call it your business name. I hope that kind of clears that up. But this is kind of one of those, some of this goes to the states. and they'll have different rules on naming. But you can call it, as long as the name is available. I know in Oklahoma that's how it goes. So like if you're trying to call your business name the same thing as somebody else, you can't if they already got it first. But you would just need to look up your state. But no, that is actually not a dumb question. I get asked that a lot of times. Okay, so let's see, more questions. Is it super complicated to move from an EIN sole proprietor to an LLC? I did the EIN sole proprietor because I didn't want to use my social security number with vendors, and I wasn't sure if I could do self-publishing. 2 years later, I'm in a different position and want to start my LLC. Trying to make sure I understand. Okay, this one, I'm going to kind of stay generic on this. This will be determined by the state that you register in. Sometimes in Oklahoma, when you're registering, like it'll ask for the EIN if there is one, or for your social security number. And so when you register the LLC, I believe you can use that standing EIN and just work it into your LLC. That would be a question probably to discuss with your accountant, and it would depend on what state you're wanting to form your LLC in. But in most states that I've done, when you form the LLC and you're a sole proprietor that already has an EIN, you just put it in there, and then that EIN becomes an LLC. Now, now that you've already got the EIN, if you convert to an S Corp later, you may have to reapply for a new EIN. And so that's where, and I get that sometimes you don't, you're working with people and maybe they're smaller companies or just people, and you're wanting to keep your social security number to yourself. And that would be a good reason to do an EIN if that's what you choose to do. I think, okay, on my next slide, my last slide, this is my contact. So I went ahead and just put my email on here. I love tax questions. And so if you do have tax questions, or maybe something you want me to elaborate a little bit more, just be aware I am a little bit of a nerd. So if I get like all passionate, you may have to scroll for a little bit. I'm more guilty of giving too much information than not enough. But I love answering questions. And even if I have to, sometimes I look at it as, you ask me something and I'm like, I don't know what this is. And I just research it. I love to research. And so I may even look it up if I can in one of my tax search databases. But that is how you can contact me if you do have questions. And I check that several times a day. It looks like there's some more. Okay, if you're a debut offer and you have deductions or expenses for your business in the tax year before you publish, can you still deduct those? Or can you only claim deductions after you publish? This is an amazing question. So yes, anything you've invested, and more than likely for the first couple of years, most businesses don't make any money, and the IRS does expect that. So yes, you could have a Schedule C with a negative amount on there, and that is going to decrease your other income. And so you'll be able to take those losses on your tax return to decrease your taxes. So that can be done. Just again, make sure when you start having losses repeating, like when I start seeing clients and they've had a loss for the third or fourth or fifth year, that's when I will have that talk with them of, you're getting into kind of some risky territory here. But the first couple of years, the IRS actually expects to see some losses. It is very, very rare that you see somebody publish and they've got all this income that first year, especially more income than the expenses they put into it. And so, yes, you can still deduct those as long as they're legitimate expenses. You can. And see here, any chance you or your company will provide services to a state outside of Oklahoma? Yes, I have done a lot of state returns. And I am open to taking on new clients. I've got a handful on my own already. And so, yes, the more the merrier. I do a lot of this work evenings and weekends and days off and things like that. And so I'm always looking for new people. And but yes, I do taxes for other states as well. I've done them for quite a few different states at this point. And so and I'm kind of getting more and more familiar. There's some kind of there's a few states that I've already worked in quite a bit before, and so I've gotten more familiar with their laws. Just email me if you have any questions or you're interested. Does anybody have any other questions? I'm happy to take on some more. Oh, and you're welcome. I'm glad this was helpful. Okay. Roseanne says, I'm not sure if this is something you can answer. I wanted to move into more direct selling on my website, but the whole sales tax thing has been holding me back. There was a change in what you have to do a return for each state where the buyer is. I'm assuming you have to have a certain amount of sales tax you have charged. It seems overwhelming to me. So this is where on sales tax, this is very state specific. And so, this can get kind of complicated because different states have different sales tax laws. Some states require you to file a sales tax return if you sell something for a penny. Some states have caps. Some states have different. So, for example, in Oklahoma, if you provide a service, you don't have to pay or take sales tax for services. So like if you're a mechanic, you don't have to, you won't pay sales tax on the services that you provide. I don't pay sales tax for people. But say I started supplying people with paper. If I started selling an actual physical item, I would need to pay sales tax on the money I received for that item. And so it is very state specific. And so I've done sales tax returns for, I think, 4 different states now. And so it's just a matter of going into that state and just researching what their laws are and what you would need to pay sales tax on. But a lot of states, anything you do within that state or even outside of that, if the sale takes place in that state, most of the time you're going to need to file a sales tax return. Some states, it's by the receiver, and so you could potentially have to pay sales tax for other states. One way around this, I guess, is using a third party. If you do business with a really good third party that is selling all of these items for you, they can keep up with the sales tax for whatever states and how they're doing it. And then you would just, that you would pay them a fee for that or something to that effect. And so it really depends on kind of what you're doing and what state you're working with and who your buyers and sellers are in what states. So this one, it is overwhelming. So don't feel bad on that. It can be very overwhelming. How do you track where your sales are coming from? They'll go by the shipping address. So whenever somebody orders something and it's getting shipped somewhere, they're going to go by where it went to. And that's how you'll track where it's coming from. If less than $400 was made this fiscal year, it reported even though it's not as much. Okay, so according to the IRS, any income you make should be reported on your tax return. If you make less than $400, you will not have to pay sales tax, but any income you make needs to be reported, no matter how you make it. So that one's they're pretty straightforward on that. The $400 just you won't pay any sales tax on that low of an amount. Looks like we have about 4 more minutes if anybody has another question. Oh, you're welcome, Roseanne. I'm glad I could help. Is that okay? Here's another question. Is that sales tax number based off of profit after expenses? This is another thing where it's calculated differently by different states. Each state has their own sales tax forms. And so this is where sales taxes can, as she said before, it's very overwhelming because when you're starting to sell things, sometimes even very, very small things like stickers or bookmarks, some states can get pretty nasty on the sales tax. And so that's where anytime you're doing business, again, working through a third party, a lot of times is one of your best, especially when it's those little bitty small things, because if you're working in 10 different states that require you to file a sales tax return on the people that bought the items, then you can start getting into doing some serious sales tax returns, depending on where the people were that purchased those items. Sometimes it's just a matter of reporting it, where you send them a form that says, hey, you purchased this item, you're going to need to pay sales or use tax on it in your state. Sometimes it's a matter of having to actually go in and get a sales tax permit and filing sales tax returns. Oh, you're very welcome, Jennifer. I'm glad this was helpful. Thank you. Is it Delphine? I probably said that wrong. I'm bad with saying names. And I have a weird name too. Are there any authors you work with that you can share? I would need to ask their permission. I can't give out who who my clients are, but if you wanted to email me with your information, I may be able to put you in touch. It would just be a matter of, I would need to get their permission. The IRS terrifies me. They can be quite terrifying. I've honestly, some of the people I've interacted with they're super cool, and you just have to remember they are people too. But some of them can be just quite ugly as well. So it's a extremes. There's different extremes. But I've actually talked to and worked with some different IRS agents that they're really cool people. And sometimes if you will work with them and you will communicate with them, they will work with you. But I always suggest that if you're getting into something and you don't quite know what you're doing, get an enrolled agent or a CPA or a lawyer, somebody that does know, so that you're not giving up information that you don't have to. And we know what information they need. We know what information they don't need. And so if it's something like, oh, they're asking you to verify your identity, definitely do that. But if they're starting to ask you for certain books and records and you're like, I don't understand some of this terminology, that's when you definitely need to get help from somebody that knows. And yes, taxes can be very intimidating. They are very complicated. I feel like I can breathe a little easier today. The IRS makes me anxious, and they can. And I know they've just hired a bunch of new auditors. They're going to be hiring even more. And so some of that is a good thing, because I have clients who have letters and we can't get through to even talk to anybody. But sometimes it's a bad thing too, because that could be more audits. One thing to help everybody maybe breathe a little easier is, I know they're going to be concentrating on those higher income earners. And if you kind of, like I said, keep good records. If you don't know something, either research it. The IRS website actually has a ton of information now, and it's very easy to read. Sometimes I go into my tax databases and I'm like, this doesn't make any sense. And I'll just go to the IRS and read the instructions. And they've done a really good job at making things, putting them in lay terms to where it's easy to understand. And so just definitely don't let them intimidate you too bad if you're doing everything the way you should. If you're the main thing is just keeping good records. If you have a record of what you did, then you're entitled to that deduction, if it's listed, of course. But having an accountant to help you with this can make it a lot less daunting. And if you are just doing it yourself, keeping records is your best friend. Okay, it looks like we went over. If you have any other questions, feel free to email me and I will answer what I can. Thank you so much for having me. I really, really appreciate it. This was a lot of fun. And so, like I said, I would love to hear from you all. Thank you.